Today, we're going to explore whether buying a unit in Brisbane is a good investment. We're going to run through the different types of units that exist around our city and unpack some of the risks that property investors need to consider. We hope you find value in this episode.
Welcome to the Brisbane Property Podcast with your hosts, Melinda and Scott Jennison.
Hi, everyone, and welcome back to another episode of the Brisbane Property Podcast with Scott and Melinda Jennison, talking about buying units in Brisbane.
Yes, welcome back, everybody. Today's episode really is focusing on, are units a good investment here in Brisbane? It's a topic we often get asked because I would say the majority of our investment inquiry that does come in, people are really focused on buying a house and land. And I think the biggest concern that we have as buyers agents and also as qualified property investment advisors is the budget that people have to purchase a property. It quite often doesn't align with what budget is required to purchase a house here in Brisbane. So it's so important that people understand what their money will buy and, more importantly, where that budget will buy the type of property that they're looking for. Because when it comes to property investment, location is very, very important because that's going to determine the value of the land. And that's going to then go towards determining the land to asset ratio. And of course, if we are looking at property from an investment perspective, we're really interested in the land value as a portion of the purchase price, which is that land to asset ratio. Now, regardless of what property type you are looking to purchase, you can still assess the value of the land as a portion of the purchase price. And that's what we're going to unpack today when it comes to assessing whether units are actually something that investors should be considering in their investment portfolio.
Yeah, it's something we talked about on the podcast. There's a test in my memory now. It's probably 18 months, 2 years ago, where we actually said, watch this unit space because the unit market space, it probably had underperformed. And we just said, keep an eye on it because I think going forward, we talked about it saying that the units it's going to change, and we thought it was going to change. It has changed. Not that we're taking all the credit for it, but that unit space in the market has changed. It's performed very, very well. Month on month for the last quite a while now. They obviously the renting side of things, they rent out very, very well. So I think for people looking to buy a unit or getting into property, units are possibly a way to go, especially from affordability side.
Yes, and if we loop right back, Scott, to when we were talking about watch this unit market, the pressure is building. That was back in January 2022. We were talking about the fact that more and more buyers were turning up to open homes for that more affordable price point. This is at a time where unit median values were less than $500,000. It was a very affordable segment of the market. And of course, now median unit values are much higher than that. They're approaching $600,000 across Greater Brisbane. So we're very much in a different market, and we've had really strong capital appreciation in that unit segment of the market, partially driven by affordability, but also a change in lifestyle off the back of COVID. You'll remember in the post-COVID boom, everybody was looking for space. Everybody wanted to be able to work from home. There was less requirement to go into a workplace. So, people were looking for larger properties. And we've seen a bit of a reversing trend in some parts of Brisbane where people are now looking to move back to the locations where there's hustle and bustle, I guess you could say, where they can walk to grab a coffee, walk to local restaurants, walk to local bars. And these types of areas where most of the units will be located. They're not going to be providing or areas where you've got that lifestyle. They're not going to be the same areas where you've got large suburban homes necessarily that are in an affordable price point. And so buyers are starting to weigh up the pros and cons of lifestyle versus property type. And they're starting to compromise on what they're prepared to live in or how they're prepared to live to stay within locations that deliver on those lifestyle benefits.
I think that lifestyle side of it's a big, big factor because as you mentioned, people want to live near the coffee shops, the cafes, the parklands as well, public transport, those types of things, which you'll probably get more units around those areas. And also the low maintenance. I have the amount of people I talk to and they I just spoke to someone earlier today that said, they don't want a lawn to mow or a big yard or any that maintenance. They want to have their weekends with the kids to be able to enjoy that. So those unit side of things and that lifestyle, I think is very, very important. One thing obviously units, there's obviously pros and cons when it comes to this type of thing. And obviously back in 2016, I think from us personally, that was the last development we actually built, which was some units, believe it or not. And towards the back end of that 2016, there was a big oversupply in units. There were cranes everywhere through Brisbane. You drive through the streets everywhere and you would see cranes in the sky. Not long after that, the cranes fell out of the sky, or they dismantled them from the buildings, because we had a major oversupply of units.
Yeah, so this all became apparent off the back of a change in the Brisbane City Council planning scheme. That update to the Brisbane City Plan occurred in 2014, and we saw a lot of land that was previously zoned for industrial use converted to high density or medium density residential zoning. And off the back of that change in the city plan, we also subsequently saw a lot of developers move in very quickly and get the approvals to develop high density units here in Brisbane. Now, the types of units that were built really didn't appeal to the owner occupier market. They were majority of those units were 2-bedroom, 2-bathroom or 2-bedroom, 1-bathroom. They were small. They appealed to property investors. And in fact, a lot of those developers got projects off the ground by advertising those properties off the plan for sale to get their pre-sale numbers up to a lot of international investors. And we saw especially Chinese investors move into the market to purchase off the plan so that a lot of those projects could progress and get out of the ground. Now, what became apparent off the back of that change in the city plans and the developers moving in is that we had a huge volume of development across the city, which resulted in a peak volume of supply hitting the market all around the same time, and that occurred in 2016. So there was a huge level of supply. Now, if you are a regular podcast listener, you will know we often talk about the balance between supply and demand is what ultimately drives prices up or down. When supply is low and demand is high, we typically see price pressure on the upside, which means prices are likely to increase. When we see the opposite, where we've got a high level of supply in an environment where you've got lower levels of demand, you will see price retraction. You'll see prices actually decrease. Now, back in 2016, that was the perfect environment where we saw a huge volume of supply. And we certainly didn't have the rates of population migration to Southeast Queensland like we do today. So we had far too many properties that had been built and not enough people to live in those properties. So we saw the demand actually fall away, or rather the supply outstripped the demand that was actually there. And because of that, we saw a lot of price softening. A lot of people who had purchased off the plan found that by the time those properties were completed and settlement was occurring, the properties were actually worth less than what they paid. So people were in a negative equity position right from the outset. And this is what happens when you've got a moving market, especially when you've got too much supply coming into the market. So that's what happened. And because of that, we saw prices for units actually start to go down, to decrease. But we also saw huge vacancy rates come into that segment of the market. And that was simply because there were too many properties available to rent. There weren't enough tenants that were able to fill properties. And in fact, we saw some of those developers putting in place huge incentives for renters to go and rent for 6 months for free. Sometimes renters would just hop from one property to the next over a number of tenancy periods because of the incentives that developers were providing to them. So obviously that's not an ideal property market situation at all, because there was downward pressure on rents, but also downward pressure on prices. And that was because of that oversupply risk.
So obviously when people are looking at units, zoning is important. Okay, so because you need to understand what that zoning is around those areas. Quite often it's obviously higher density. So you need to be aware of the zoning in those areas and what's planned for those areas. The other thing you consider is obviously the the state of supply. So the potential for that future supply, because not all areas are the same, are they?
That's exactly right. And I think anybody that understands that Brisbane City Council planning scheme knows that there are only certain pockets within our capital city market where land is zoned for these higher density unit developments. And when we're talking about units, all units are grouped as one when it comes to representing unit changes in terms of the data. So whether you are purchasing a unit in an area dominated by low density homes where you might not see any units above 2 or 3 levels in height, or whether you're purchasing a unit in the inner city precinct where you've got multiple levels of units and hundreds of units in a single complex, all units are grouped together. However, I think it's very obvious to anyone that a unit in a high density complex is going to be a very different investment opportunity compared to a unit that may be in a location where you have only 4 or 5 units on a block of land in a decent area with no potential for higher density supply. So you can see already where we're heading with this conversation. Not all units are the same, and it's very important that you understand the area in which you are buying, not just what it looks like today, because as we found out previously with the zoning changes, when high density development comes through nearby, that can have an impact on even the established dwellings in those locations. So it's really important to understand which areas are zoned for higher density development but not yet built out. And there's plenty of those pockets around Brisbane.
And when we start to talk about the older units, for example, and the newer units, obviously there's, again, very different when we talk about those sort of things, because generally and this is a general sort of thing, obviously, the older units tend to have been a little bit bigger when they were built. So you probably get quite a larger floor plan or bedrooms. Yes, they're a little bit dated and they're a little bit older. A lot of them are still livable. They're still nice and solid. You can renovate them, repair them, improve them, and add some value to them that way. Whereas obviously the new ones, there's depreciation benefits on these side of things as well. So understanding the different types of units, not just the density and the zoning, but also the different styles and the different kinds of units are available as well.
Yeah, agree with you there, especially from an investment perspective. If you are purchasing a new unit, there will be some very strong depreciation benefits that you will obtain. And I know some people talk about investing in property for tax benefits. That's certainly no reason to invest in property as a primary driver. It's a secondary consequence of an investment strategy. But, you know, any property that you purchase into has the ability to have depreciation benefits. However, it must be a new property to get the benefit of fixtures and fittings being a depreciable item now that there's been some recent changes in those laws. So if you are buying an established property, you will only have depreciation benefits if there's been some fairly recent renovation occurring inside that particular complex, because the majority of the building itself will have, completed its depreciable life. So again, get some advice from a quantity surveyor if you are looking to purchase a unit. If it is a newer unit, there will be more likely to be depreciation benefits compared to an older unit, but quantity surveyor will be able to provide you with a depreciation schedule so that you really understand what benefits might be available for each asset type.
Obviously, the larger the blocks of units compared to the smaller ones, the scarcity side of it comes into play as well.
Yeah, it does. And, you know, we always talk about scarcity is what ultimately drives value. If you are purchasing in a complex where there might be 70 or 80 other identical properties across multiple levels, when your property becomes available for sale or when your property becomes available for rent, there's no scarcity around that particular product. Compare that to a unit that might exist in a blue chip location that might have the scarcity of a mountain view or a city view. It might be in a complex of 5 or 6. It's an elevated location, and the floor plan is quite unique in that there's no other properties in that location that will have a similar aspect or a similar floor plan. That provides a level of scarcity, and it's the scarcity factor there that drives the value. In addition, when we look at the land to asset ratio in both of those scenarios, if you are purchasing one property that exists in a complex of 80, and that might be on a 2,000 square metre block of land, the amount of land that you're buying as a portion of that total purchase price is very, very low. And so you spend so much more on the building itself in terms of the purchase price. And the building is the depreciable part of the asset. So it is the part of the asset that will decline in value. It is the land that ultimately causes the appreciation or the capital uplift. Compare that to purchasing in the small complex in a location that has that scarcity. You'll still have a larger portion of land if there's only 5 or 6 units on that block of land. So the land to asset ratio is much higher when you're purchasing in a smaller complex. And therefore, you will have a larger portion of the appreciating part of the asset compared to the building itself, which is the depreciating part of the asset. I hope that makes sense.
So the other thing which we'll touch on very quickly is obviously when it comes to the bigger complexes compared to the smaller complexes, you got things like your body corporate fees and holding costs as well. When it comes to that, you tend to probably find on the larger scale unit complexes, your body corp fees are going to be higher. There's more to maintain in the properties. And then when you put things like gyms and pools and things like that, obviously there's that risk of extra costs from the body corporate side of it.
That's right. Yes. So obviously any investor is looking at their net return more so than their gross return. So that is the amount of income or the cost to the investor after all of the expenses are taken out. And body corporate fees can really hinder that cash flow position on a property because they can eat away at the net return. So regardless of what your gross return is, it's important that you're accounting for the costs associated with holding the property. And in the case of units, there will be that cost of looking at body corporate fees. So the fancier the building, the fancier the gym equipment, if there's a lot of elevators and lifts and pool areas, common areas, it's generally going to increase the cost associated with your body corporate contributions. So that's definitely something to look out for when you are assessing those body corporate records.
Now, when these larger complexes are built, generally what you find is the developers, builders, whoever's funding the project, a lot of the funds that they actually get, you'll need pre-sales. So by that, I mean, obviously they need to sell properties, so you need to get a commitment of people to buy a certain amount. Once you get that percentage of sales, then obviously you're funding the bank, whoever you're borrowing the money off, will fund the project so it can go ahead. So that's a big thing to understand, and the risk involved when we start to talk about when people say they want to buy off the plan, there's also a major risk in that as well.
Yeah, there is. As you've pointed out, most developers do need to meet pre-sale targets when it comes to obtaining funding before construction is commencing. And this is one of the reasons why today we're seeing far fewer units being developed. So as I pointed out previously, back in the 2016 peak, when we had huge volumes of units being brought to the market all at once, we had the ability, or rather a lot of international investors had the ability to buy into the Australian market and specifically into the Brisbane unit market. And that helped these developers to get projects out of the ground. Now, the Foreign Investment Review Board rules have changed. So foreign investors, there's a lot more restrictions on what they can and cannot do. And there's a lot more cost involved in investing from overseas. So that's really slowed down that pipeline of foreign investors investing in property. And therefore, it's made it harder for developers to meet those pre-sales or pre-construction sales targets that they do need to get the funding to bring these projects to fruition. So the circumstances are very different today compared to 8 years ago when we had that peak supply of units in Brisbane. And also, you know, when properties are being sold off the plan, it does come with a level of risk, and property buyers need to understand that a pre-sales contract or an off-the-plan contract requires you to put down a deposit, and that deposit might be $50,000 or $100,000, depending on the value of the unit that you're looking to purchase. And For some of those contracts, there may be the ability for the developer to refund that deposit 2 or 3 years down the track if they can't get the project out of the ground. Now, obviously, that's a lot of money for you to have tied up in something that you hope is going to be delivered. But if there is that opportunity that or that risk that the project may never get out of the ground, there's a huge opportunity cost of being out of the market for that period of time. So that's something that you must take into consideration if you're looking to buy off the plan. In the past also, we saw there were some premiums being paid for off the plan properties. And as I've pointed out, by the time some of the properties were delivered to the market, the value was actually less than what some of the contract commitments had been. So people were having to settle on a price that was actually higher than the current market price. Now, that is the risk that can occur when you're buying off the plan as well. There's upside benefits if the market has grown in value during the construction period, but there's downside risk in that the value of the property might actually decline during the construction period. And remember, your commitment to a pre-sale contract is at the time you're signing the contract, which can often be, years ahead of when that project is actually delivered.
And obviously making sure the right finishes are done, obviously all those types of things, you need to understand all of that, because if you buy off the plan, you need to know exactly what the finishes are going to look like, because that could change. But there is that risk, as you said, buying off the plan. I mean, the other thing is the construction side of things. Builders, we see builders going broke and closing up shop. So if there's hiccups like that along the way, that can have a major effect on you if you've bought off the plan as well.
One thing I will say, and I've got some data here from the CoreLogic Pain and Gain report from the last quarter of 2023, 1 in every 20 units that were sold in Brisbane in that last quarter of 2023, so that's the 3 months up to December last year, they traded at a loss, despite the fact that we're in a property boom. So that's 5.6% of all unit sales actually still made a loss at a time where the Brisbane unit market has been escalating rapidly at a median value level. And of course, the housing market has also been growing very strongly as well. Now, that just in itself highlights the fact that not all units are created equally, and that in areas where you've got too many of the same thing or an oversupply, it can really detract from value. And so it is so important as a property buyer that you understand the risk associated with buying something that has no scarcity factor. If you're just buying one of many that's in the same complex, it can bring some downside risk in that regard because of that lack of scarcity and the high level of supply of something that's not scarce at all.
Understanding your zoning. We talked about that earlier, the zoning in the areas around you as well, because if you are buying in a higher density area, you need to make sure that what's happening around as well, because the last thing you want to do is buy something, especially if you're buying off the plan, and next door to you when you've got a nice view and you think it's beautiful, and all of a sudden by the time it's finished, you've got another development happening next to you. So you need to understand the zoning, what's planned around you, to make sure that you are really organised when it comes to that type of thing. That's probably more buying off the plan as opposed to those established units.
Yeah, I'd also say there is an element of understanding the zoning around you, even buying established, especially, for example, if you're buying something that's got an amazing uninterrupted city view. If the zoning for properties between that complex and the city is for high density, then your view may be built out. So you might be paying for something that may no longer exist in the future. So it's absolutely critical to understand, what's going to happen around you in terms of the surrounding development, or what might actually already be approved in terms of those development approvals that are already in the pipeline, because this gives you an indication of, what the area might look like in the future. Now, in-house, we study this sort of information. It's how we are able to make recommendations on which locations are likely to remain low supply locations into the future. And we study things like the Southeast Queensland Regional Plan to get an understanding of where are the future pockets of high density development likely to come through. The state government provides the regulatory framework to guide local government council areas on land zoning precincts. So that Southeast Queensland Regional Plan will be used by local councils in the event that we have another update to our city planning scheme. It'll be driven from information within that overall state government plan. So it is important for people to get an understanding that things do change. However, generally pockets of development are discussed well in advance of those pockets or of that rezoning coming through. And that's obviously where a team of professional agents who really understand that local area can really guide you to ensure that you're not buying in a location where there's going to be supply risk in the future. If I can just point out how much Brisbane has changed recently, I've got some really interesting data here in terms of what's been happening in terms of the volume of units in the Brisbane market historically versus the volume of units today. Now, we often talk about the fact that Brisbane is not the same city as the likes of Sydney and Melbourne, and we're much more underdeveloped compared to those two capital city markets here in Australia. But if I can talk about the volume of unit sales as a percentage of all dwelling sales here in Brisbane, back in 1993, only 19.4% of all dwelling sales were made up of unit sales. So that's a very small portion, less than 1/5 of all sales were a unit here in Brisbane. By 2018, that number increased to about 30%, so just under 1/3 of all transactions. But just last year in 2023, we're now just under 50% at 49.5%. So if that doesn't tell a story of just how much Brisbane's infill development has changed since 1993 through to 2023, it's so important for people to understand just how much we have experienced that change. But one thing I'll also point out is that the majority of that change really did come through in those latter years of the around the 2016. That's when we saw that huge influx of supply, and it came through in about 2 or 3 years. There's definitely been more projects constructed and completed since then, but the volume of those has really slowed down on an annual basis. So we're now seeing supply not keep up with demand, because what's also happened is we've had this huge influx of migration, both from interstate and overseas. And remember, a lot of our overseas migrants are very happy to live in units as opposed to houses, because it may be the way that they're more familiar with living. And we've also seen that shift in that buyer demand based on location-driven drivers, as opposed to living in a larger property, living in a smaller property, but in a more premium location. And that's all putting pressure on that unit market here in Brisbane and driving those values up, which is something that we've now experienced for the last couple of years.
I know that at the start of our listeners are probably thinking, oh, it's all negative and very negative about units, but we understand the risk side of things, so that you need to really open it all up. And when we talk about the risk of that, more probably the higher density type of side of things, as opposed to, as you said, units. I mean, look, 50% of the sales now are units. So units are popular, and there's a reason for it. I mean, units they're affordable. So if people are looking to get into the property market, you can get a unit which is more affordable. That type of product will rent very well. So they've got really strong yields. And then obviously in the future, when life changes and you earn more money, that could roll into the deposit for a house, or it could become an investment property, which is a very good investment property then, because as I say, they're affordable, they're rentable, they've got good yields, and they're very low maintenance. So if you don't want to take the risk of buying a house that you need to maintain, and you need to understand then that when you buy a house, you maintain the yard, the fences, everything out externally, you maintain that as well as internally. In a unit, you've got the body corporate side of it, which maintains the external. You're responsible for inside. If you want to renovate, it's generally a lot cheaper, because it's a smaller area you need to renovate. So your costs are going to be reduced. So units, obviously, if people want to get into the market, I think the unit space is a fantastic place to start.
Yeah, it's a good point. And when you look at the median house values here in Brisbane now exceeding $900,000, when people talk to us at Streamline Property Buyers about, budgets of $550,000 or $600,000, the locations that you need to move to purchase a house for that value really are on the outskirts of Greater Brisbane, in areas where there's just an abundance of land still available. And we still talk about supply and demand, and compare that with, potentially locations where you've got inner ring suburbs with low density of supply, a limited number of units available, but there's going to be that scarcity factor. But you're going to be then in locations where people are on higher incomes. You've got a higher socioeconomic demographic. People that rent there can pay more for rent because they do have higher incomes. You're closer to employment hubs, you're closer to lifestyle hubs, you're in the premium school catchment zones, etc. So there's a lot to like about those types of investments when it comes to selecting an asset that might meet your needs. But as I always say, and it is absolutely critical, no one asset or asset type suits everybody. And it is so important to get advice based on your personal circumstances and based on, what budget you're working with, what your appetite is for risk, but also what you're trying to achieve as an investor. We're finding in the higher serviceability environment, there are a lot of investors that have some rental requirements that, have to accompany their funding, which means the bank will not give them the money unless they achieve a minimum amount of rent per week. So in order to achieve some of those rental targets, because of the yields in the unit market being significantly higher than the yields in the housing market, quite often that is the only way that they can actually move into an investment, because they need that higher income. So again, everybody's circumstances are going to be unique, and purchasing units as an investment is not going to be for everybody, but it's certainly something that does appeal to a segment of the property investment market. And if you need advice as to whether that's you or not, obviously you are welcome to reach out to our team here at Streamline Property Buyers, because that is what we do in terms of our day-to-day activities.
And it could be a bit of diversification in your investment portfolio. 3 takeaways from today.
Look, I will say not all units are created equal, and I think I've made that very clear. There's high-density units, there's low-density units, and you need to understand the surrounding areas. So that's takeaway number 1. Number 2, unit values are also driven by supply and demand. So you must understand where you're buying and what the future supply pipeline for more related stock is likely to be in that particular area. Weigh that up with the demand for that product type in the area, and that's going to help you understand the long-term direction of prices. Final takeaway, affordability. Units do provide an affordable entry point for a lot of buyers, and they do have higher yields. So if you're an investor with a more limited budget, potentially needing some more income to help you with serviceability, then it might be an option that appeals to your personal circumstances.
Fantastic. Hopefully that's been some great information for our listeners when it comes to looking to invest into units here in Brisbane. So look, as usual, I will let Melinda wrap it up. It's been great talking, and hopefully our listeners got some good information out of that. And we look forward to sharing more information, more guests through our podcasts coming up. So as usual, I'll let Melinda wrap it up. From me, take care and bye for now.
Thank you once again for joining us on the Brisbane Property Podcast. If you have enjoyed this episode, please don't forget to leave us a review, share the episode with friends and family. It really means a lot to us when others get to benefit from the information that we prepare. As always, we look forward to speaking with you again next week. Bye for now.